Good afternoon, and thank you for taking time away from your clients and colleagues to join us for this Epic Insight. This is Brian Lenz, Director of Sales here at Epic Retirement Plan Services, and I'll be your host for today's call. To share the latest news from Washington, we're privileged to be joined by retirement industry veteran and insider Brad Campbell. Along with Brad's insight on the regulatory environment related to ESG investing within retirement plans, Mary Green, Client Portfolio Manager for Federated Hermes, will offer an introduction to ESG and the Responsible Investing Institute. First on the mic will be Mr. Brad Campbell, partner at Thayer Drinker, Biddle and Reith. He is a nationally recognized figure in the employer-sponsored retirement plan space who counsels his clients in ERISA Title I issues and litigation, including fiduciary conduct and prohibited transactions. Your line will be muted throughout the call, but if you have any questions you want us to discuss at the conclusion today, feel free to enter those in the questions panel, and I will run that by Brad and or Mary. With that, I'll turn it over to Brad.
All right. Well, thanks, Brian. And I don't think I've ever had anyone introduce me as being first on the mic. That's a way more exciting way to talk about doing this than ERISA lawyers normally are allowed to be. So appreciate that. But most importantly, thanks to all of you for joining in today to talk about what's going on. And there is a lot going on. We've got a lot going on in Congress. We've got a lot going on at the Labor Department and even some of the states. So we've just got a lot of activity that's affecting us. And it's because, of course, we were ending the Trump administration and starting the Biden administration. And that's resulted in a whole bunch of regulations that were put out mostly during the last year of the Trump administration. And the Biden folks are having to decide which of those they're going to kill, which they're going to keep, and which they're going to modify. So that's a lot for them to be doing. We're also still waiting for them to give us their actual agenda on top of how they're going to deal with some of those issues. And then Congress is actually a very different place than we envisioned it to be shortly after the election. As you all recall, the Democrats now control the House, the Senate, and the White House. And that unified government is something we haven't seen since the beginning of the Obama administration. And that was a pretty momentous time for congressional legislation. That's where we got the Affordable Care Act and some other pretty major bills. We're having the same set of situations going on now. And for us in the retirement space, it's kind of resulted in kind of a bizarre reality. Going into the January period, before we knew who was going to control the Senate, the expectation was that probably the only real legislation that was going to affect retirement plans would be the Secure Act 2.0, or the son of the Secure Act, or whatever you like to call it, the new Portman-Cardin legislation, basically the new round of pension changes that everyone likes, that had wide bipartisan agreement. So that was kind of what we figured the pension bill would be for this Congress, to the extent there was one. Then when Democrats got unified control of the government, that agenda changed quite a lot, because with the Democrats controlling the Senate, albeit by the absolute slimmest of majorities, the agenda is much more ambitious than it was. And so we're seeing Congress turn its attention not just to multi-trillion-dollar stimulus bills, but that almost impacted retirement. Because when they were doing that stimulus package here a month or so back, one of the ways they were trying to pay for it was to get rid of the indexing for employer-employee contributions to retirement plans. Fortunately, they didn't do that, but it was on the chopping block as a revenue raiser for a short period, and seriously so. That's a good illustration of when some bills unrelated to retirement are going through, they can still end up affecting retirement plans, because we're a place that they often look to gain some revenue. If they can tweak the tax treatment on retirement plans just a little bit here and there, they can miracle up some real money. And use that to pay for other things. So we have this sort of existing danger that we could see changes in the retirement system sort of as an incidental effect of other laws they're pursuing in bigger issues. But second from that indirect situation, we also have the direct situation, which is President Biden had some campaign proposals regarding the taxation of retirement plans that we're probably going to see some details on shortly. And while I don't know that they're necessarily going to make it through Congress, they're definitely going to be in the discussion. And one of the big potential changes is that President Biden as a candidate suggested that our current system really is not efficient or fair or equitable because of the way it bases the tax benefit that you receive for a contribution on your deduction. In other words, on your tax bracket. If you're in the 35% bracket and I'm in the 10% bracket and we both put in $1,000, well, you get $350 for the tax benefit and I get $100. And their argument is that's not fair or equitable. It benefits more highly compensated employees. Now, I personally don't know that I agree with that analysis, but that's their view of it. And what they're likely to propose, although we haven't seen the details yet, is some sort of standard credit rather than a deduction. So for example, and again, we don't know the details, but it might be that they say, well, for a $1,000 contribution, everybody gets $250 worth of tax benefit. And if that's the case, that would certainly have the effect of reducing the value of contributing to a qualified plan for more highly compensated workers and increasing it for less well compensated workers. The result of that is some change in the incentives, particularly for small employers to offer plans. So all these things that are in the mix, the discussions that are being had about changes to the tax code that are part of this infrastructure bill that Congress is working on, those are all issues that could affect us directly and indirectly that we need to keep our eyes on. Now, about the things that we all agree on, the Secure Act 2.0, those are moving. The Ways and Means Committee just last week marked up that legislation, meaning they got it out of the committee, they passed it through the committee, and they did that by voice vote. And it's pretty darn rare that you would have both Republicans and Democrats agree to substantive legislation by voice vote. And that shows exactly how strong the bipartisan cooperation on those issues are. And that bill includes things like allowing student loan repayments to be the basis for matching contributions in the employer's plan. It includes things like increasing the RMD age from 72 to 75. It includes allowing 403Bs to be part of PEPs and invest in collective trusts. So there's a lot of change in that bill that people like, but oddly enough, because there's unified government, it's probably taking a bit of a back seat to some of the current debates we're having on these more difficult issues. So I do think Secure Act 2.0 is going to pass, but I don't think it's going to happen in the short term. I think it's more of an issue for later in the year. And of course, let me also say, of course, nothing is ever done until it's done with Congress. So while it looks very favorable for Secure Act 2.0, it probably will take a little while before it actually happens. And there's always the potential that Congress will manage to not do anything at all. But leaving that aside, let's turn at the regulatory agenda for a little bit and look at where we are on some of the big picture issues that the Labor Department is running with. So it's fair to say that the Trump administration, while they certainly did some regulations and some guidance in the first 3 years, saved most of their energy for the fourth year. And so we had a lot of major regulations that came out of DOL in 2020, some of which were finished and went into effect, some of which were finished and were kind of handed over to the Biden administration to let happen or not. And so the Biden folks have been sorting through that since day one. And one of the issues that they put out there that they're having to deal with is lifetime income disclosures that are required for plans, for defined contribution plans. So in other words, under the Secure Act, the one that passed a year and a half ago, Secure Act 1.0, you have to, as a plan sponsor, as a plan administrator, you have to put out a lifetime income or a retirement income estimate in the form of sort of an annuity payment based on certain assumptions for an individual's account balance at the end of the period. You have to do this estimate at least once a year. That would show the retirement income from their current account balance. And the Congress left it up to DOL to write the rules on that. The Trump administration wrote a rule last September, and they took comments on it. It's what's called an interim final rule, which means that what they put out last September will go into effect this September unless the Biden administration issues a new rule or changes it. What the Trump administration put out was a rule that's frankly a little simplistic, and I think is going to cause some questions for a lot of plan participants who actually look at the disclosure, that being one of the caveats. So for example, and what I mean by simplistic is that it doesn't take a young worker with a small balance and roll that balance forward to retirement age and then calculate an annuity. it says, hey, 25-year-old, we're going to pretend that you're 67 today, and that today, let's say it's the end of the year, and today at the end of the year, you have $5,000 in your account. So you're going to get $18 a month in retirement income, or $15 if you're married. Well, that may be a simplistic way to do it, but I think it's going to engender a lot of questions from the folks who get that disclosure about what it means. Why is this number so low? How do I understand this? And so folks have written in the comments, and the Biden administration will get to decide whether that simplistic approach is the right one, or should they have some mechanism for rolling the balance forward to then make the projection. And the reason all this matters, of course, is there's a safe harbor that goes along with using DOL's methodology. So will the one-size-fits-all government approach, A, how flexible is it going to be? And B, will it chill other types of education and projections that record keepers and advisors and others will make, because plans will want the certainty of the safe harbor? These are all questions that the Biden administration is looking at and is going to have to make a decision fairly soon. They have the opportunity to do a new final rule without going through notice and comment, because the way interim final works, comments have already been taken. So the Biden folks could go ahead and just change these rules. And if they do it before September, enough in advance, we could have this rule go into effect with new standards. If they do nothing, it'll go into effect as written in September, which means it'll apply to the quarter. Typically for most plans, it'll be the end of this year. So these disclosures will start going out in January and February for most plans. So this is an imminent rule that's going to have a real effect in the near term, and we're waiting to see what the Biden folks are going to do. They haven't announced one way or the other what they're going to do with this rule, or if they're going to tackle it. So we're all going to be watching that to see, because obviously the closer we are to December, the less time, or to September, the less time there is to adjust to whatever changes they might make. Another big issue that the Biden administration is building on the Trump administration is the expanded fiduciary definition for rollover recommendations, and also the new exemption, prohibited transaction exemption 2020-02, the new exemption that goes along with that expansion. So just so we're all really clear on where that leaves us, because I think a lot of folks have been confused as to exactly what's going on. Since February 16th, the Biden administration has ratified and agreed with the Trump administration's guidance. And what that guidance says is the way to properly interpret the 1975 regulation that decides when you're a fiduciary for making a recommendation to a plan or a participant. They've decided that it means that most rollover recommendations now will be ERISA fiduciary advice. In the past, most of them were not, unless you were a fiduciary to the plan the rollover was coming from. They've now reversed that and said, if you intend to have an ongoing relationship with this person, with the participant you're giving the rollover to, even if you've only talked to them once, if you intend to have an ongoing relationship once the assets are in the IRA, for example, then that is fiduciary advice, because it's the beginning of an ongoing relationship, and the fiduciary duty attaches from the beginning. So what that means in practice is, whether you have a relationship with the plan or not, if you tell a participant to do a rollover, you advise them to do that, you go through all the prudent process of evaluating it, it is fiduciary advice. And that means it's also a prohibited transaction. And I think this is the part that's stumbling a lot of, or confusing a lot of folks. If you make this rollover recommendation, it's viewed as affecting your compensation with fiduciary advice, because you're either getting new compensation or different compensation than you were before. So anyone, even if you're a flat fee RIA, you have a prohibited transaction by virtue of getting paid at all. And that means you have to use one of the new exemptions or one of the old exemptions to allow that to happen. The new exemption, 2020-02, is modeled on regulation best interest. It had a lot of conditions when the Trump administration put it out, and the Biden folks have recently issued guidance that adds even more conditions. That needs to be in place by December 20th for folks who want to use that exemption. And so it's creating a lot of confusion. All of your various institutions, banks, record keepers, that's not record keepers, sorry, registered investment advisors, broker-dealers, banks, and insurance carriers, they're all working on developing the processes and procedures, policies and procedures that are necessary to implement that. So I think a lot of folks need to be looking to the home office to find out what the rules are going to be, how they're going to mitigate conflicts, all of the issues associated with that. And this is the beginning. DOL says they're going to take a run at changing the fiduciary definition in addition to this guidance, and they're going to look at changing the exemptions in addition to what's already there. So we're starting a very similar process to what we saw in 2016, and that's going to affect everybody who's recommending rollovers in particular. So lastly, I wanted to follow up on the other big rule from the Trump administration that's caused a lot of confusion, and that's the rule, what we like to call the rule formerly known as the ESG rule. And we say that because when DOL proposed it last June and then finalized it last November, it went through a radical change. The first iteration really was focused on ESG investing. And it said, hey, we want you to hold ESG to some additional scrutiny. We want you to look at various extra factors that we don't make you look at for any other investment. And everyone pushed back. And by everyone, I mean literally thousands of comments were received by DOL. Obviously, there were people who wrote in support of their proposal, but pretty clearly across the industry, whether it's consumer groups, industry members, all over the place, folks said, hey, you've got this wrong. This isn't how ERISA works. And you don't understand ESG as well. And DOL responded to that by coming out with a final rule that said, okay, we're no longer talking about ESG directly. We're just talking about any factor that a fiduciary uses to make an investment decision. That factor should be what they call pecuniary if you're going to use it. So that was a new word that kind of captured what I think is really an old idea. The new word meant that if a prudent fiduciary determined that a factor they were going to use, whether it's an ESG factor, whether it's past performance, whether it's the tenure of the managers, whatever that factor is, if you were going to use it, you had to determine that it would have a material effect on the value of the investment over the time period the plan was going to hold it. And if it met that pecuniary standard, you could base your fiduciary decision on it. If it didn't meet that standard, it was considered a non-pecuniary factor, and you could use it for a tiebreaker, and it could otherwise be present in an investment, but you couldn't select it on the basis of that unless it was a tiebreaker. Everyone came away from that very confused. There was new terminology. It wasn't clear how it differed from the prior guidance. You had this proposal that seemed anti-ESG, even though the final rule wasn't. And the effect was a lot of confusion. The Biden administration, this rule went into effect on January 12th, 1 week basically before the Biden administration took office. And in their first 5 days, they looked at this rule and said, President Biden issued an executive order saying you need to look at this rule along with some other rules that are, in my view, anti-environment and figure out whether it's good or bad and what to do with it. And DOL did that. And in March, they put out guidance that said, look, we've reviewed this rule, this financial factors rule. We think that it's confusing to folks. We think it was kind of rushed in its development. We think that it did not recognize the important role that ESG plays in making retirement decisions. We think that it is chilling investment in appropriate ESG. In other words, this rule is causing people to avoid ESG because of this perception, this false perception that it's more risky or somehow inappropriate. And so the DOL said, we are not going to enforce this new rule. So this new rule that just went into effect in January, we DOL will suspend the enforcement of it. And we're going to write a new rule to replace it that recognizes the value of ESG investments and that will, prevent folks from having these concerns. So in the meantime, that's left a lot of questions that we've heard from plans and advisors saying, okay, well, where does that leave us? If the old rule is suspended and the new rule is suspended for DOL enforcement, it does technically still exist on the books. So if the old rule is suspended and the new rule isn't yet written, what do we do in the meantime? And the answer to that actually is pretty straightforward. If you have been employing a prudent fiduciary process in the past that took into account all the relevant factors for an investment, then it really doesn't matter whether it has ESG factors or not in terms of its fiduciary prudence. An investment that you're evaluating that passes the screens of your investment program is prudent, whether it has ESG factors or not. If it doesn't pass your screens, it's imprudent, whether it has ESG factors or not. So if you just view ESG as a side issue, then simply putting investments through your normal process, both ESG and non-ESG, will yield investments that are prudent on the other end, and you can select the ESG investments from that. Secondarily, again, there's no reason a prudent fiduciary can't look at ESG metrics and say these are actually material to an analysis of this investment as a fiduciary matter. And there's a growing acceptance as what's emerging as a generally accepted investment theory that this is the case. If you look at the performance, investments that have ESG factors have performed extremely well for the past 10 years. There's some suggestion that that good performance on some of those metrics is associated with reduced volatility and associated with better management, and that there is a place to use ESG factors as one of the many tools that fiduciaries use to analyze investments. So in the meantime, I think the message we should pull from what the Department of Labor recently did is that ESG investing is appropriate for ERISA plans, that if you go through your normal fiduciary process and consider investments that have ESG features, you should be you should feel perfectly comfortable selecting the ones that pass through that screening. The one thing I would say where you need to be wary is so-called negative screening. In other words, if you or your client were to say, well, we only want to invest in ESG funds, that's where I think you might have a fiduciary concern, because you're necessarily excluding a large chunk of investments from being reviewed at all. And that seems imprudent. But if you're including ESG and non-ESG investments together, your prudent fiduciary process should hold you in good stead for now, while DOL fine-tunes the new rule, which we'll probably see proposed later on this year. So Jim, with that, I better turn myself off because I can keep going because there's always more to talk about, but it's probably time to turn it over to you and Mary and some folks who can talk about things more intelligently than I.
Perfect. Thank you, Brad, for those comments. I really appreciate it. So, and thank you to Brian, too, for having us on the call, and thanks to everybody for joining us today. So I'm Jim Wojak from Federated Hermes. I am the DCIO that covers the Northeast for us, and I have the opportunity to introduce Mary Green today. Before I do that, I just want to say a couple of quick words. For those of you that might not have connected with your Federated Hermes salesperson over the last year, you can see that we've changed our name and also our logo. So we went through a rebranding in February of 2020, right before this pandemic hit. So it might not have been the best time to roll out a new brand, but we're happy that we did it. And the reason we changed our name to Federated Hermes is to reflect a acquisition that we made back in 2018. So the higher ups here at Federated saw the writing on the wall that ESG was going to become a bigger factor in the future. And we merged with a company called Hermes. They were very similar to us, an active shop based out of London that has a great footprint in Europe and also in Asia, which we didn't have that much expansion in. So it really helped us there. But then even more importantly, they had a great specialization in ESG, really pioneers in the industry over the last 3 decades. And we brought that expertise to join with Federated's expertise in the investment management here in the US. And we formed this new company, Federated Hermes, and really happy about what we're doing. So with Brad's comments on ESG, we just want to give you a better outlook on ESG and a better understanding of how ESG can help really your 401k lineups and your plan sponsors 401k lineups. So I'm going to let Mary dive into that a little bit deeper. Mary Green joined us in 2019, and she is really a resident in-house expert when it comes to all things ESG here at Federated Hermes. She has 25 years of industry experience. And with that, Mary, I'm going to hand the floor over to you. Thank you for your time today. The floor is yours, Mary.
Thanks so much, Jim. I really appreciate the great introduction, and I'm really here today to show you how Federated Hermes uses ESG considerations in the investment process in support of improved long-term risk-adjusted returns. We have a saying here at Federated Hermes that we are guided by our conviction that responsible investing is the best way to create long-term shareholder value. We say responsibility works. And so I'm going to give you a little primer on ESG 101. I'm going to address some myths. I'm going to talk about the types of approaches that Brad touched upon. And I'm going to talk about how ESG behaviors and active ownership add value to the investment equation. So let's get started. So you all know that there's tremendous momentum behind responsible investing. On the left are all PRI signatories, and this great growth that you've seen since 2006 through 2020 shows that the volume of assets that are being managed responsibly has grown. Now, I'd like to share with you that Federated Hermes was an author and founding signatory through our international business, the Legacy Hermes, an author and founding signatory of PRI back in 2006. And we are now joined by close to 4,000 other asset managers and asset owners who have committed to incorporating ESG into their investment process. And on the right, you see this incredible hockey stick of flows into sustainable investments. This is by Morningstar. So 2020, there were just over 50 billion in net flows into sustainable products, which represents more than 10 times the flows in 2018. It was around 5 billion at the time. And that at the time was a high watermark. So there's tremendous momentum here. And your plan participants are clamoring for this. We've done a lot of survey work at Federated Hermes, and I'd like to focus on the upper right-hand side of this slide, saying that 90%, 9 out of 10 advisors report being asked about ESG by their clients and responsible investing. Another really important stat that goes alongside that is that less than 25%, that is 24% of advisors, report being comfortable talking about responsible investing and ESG. And so we're here to help at Federated Hermes. We're launching the Responsible Investing Institute for investment professionals like yourselves to really come up to speed on ESG, this huge emerging trend. And we'll talk a little bit more about that later. But there are 3 modules. They are CE credit approved. You can get up to 3 CE credits, ESG 101, ESG implementation in the investment process, and then ESG within your business. So just taking a step back, this is the ESG 101 portion of the talk. What is ESG? Now, here's one of the myths. ESG is not an investment approach, okay? ESG is data, and these are the material, non-financial factors that can have long-term financial impacts for a company. And they're in 3 different pillars, if you will: environmental, social, and governance. So within the environmental pillar are things like climate change, climate transition, deforestation, resource depletion, waste management. Everything human related is in the S column, social, and that's really come into play in this last year. Human rights in the supply chain, working conditions, diversity and inclusion, employee relations, health and safety, public health. So you can see how the pandemic has really shown us a spotlight on social issues. And if you think about it, living through many governments' decisions to pull back on economic activity in order to save human lives, that's the biggest ESG decision of our lifetimes, and we've just lived through it. And so it should make it easier for you to talk about it with your stakeholders and your constituents. And G, of course, is governance, executive pay, board composition, bribery and corruptions, tax strategy. So here's some proof points. I know that you are looking for the proof points that ESG considerations add value to the investing equation. So these are the results of meta studies or studies of studies that prove that ESG is more than just a feel-good factor. As a matter of fact, at Federated Hermes, ESG is not so much about expressing values as it is about creating value. And you can see how ESG supports value creation here. So in these meta studies, 90% of the reviewed studies that show ESG, sound ESG standards lower corporate cost of capital for a company. 88% of the studies reviewed show that solid ESG practices can improve operational performance. So think about that. If a company has poor corporate culture and poor employment practices, they're going to have higher turnover. They're going to have to be rehiring employees, reskilling and retraining employees, and that is expensive. There are costs associated with that. And so if you have strong employee relations and strong working conditions for your employees, you're going to lower turnover and improve your operational performance. And in the all-important market performance, 80% of the studies reviewed show that stock price performance is positively influenced by good corporate responsibility practices. So here are some results of some in-house work that we've done at Federated Hermes, looking at the impact of ESG practices on financial performance. So this shows the average monthly total returns of companies in the top decile and lowest decile based on proprietary ESG scoring. And you can see that the top decile is the dark bar, the lowest decile is the light bar, and governance has the biggest impact on financial returns. So this is the average monthly total relative return. If companies with strong and improving governance can add up to 24 basis points of alpha on a monthly basis. Similarly, in the social column, up to 17 basis points of relative performance monthly. And environmental performance is also, there's also a positive effect, but it's not as statistically significant. So when investors are interested or beneficiaries are interested in ESG or in responsible investing, there's a number of things that they can mean by that. They could be looking for ESG in the driver's seat or ESG in a supporting role. So investors who are looking for just solid financial performance, risk-adjusted returns, would probably look to ESG integrated strategies. So those are strategies that incorporate ESG factors into the investment process in support of better risk-adjusted returns. So you can mitigate risk by putting the ESG considerations into your investment equation. And as you move across the spectrum of outcomes from pure financial outcomes to more mission-based outcomes, these are investors looking to express values or to make a difference. These are what are considered sustainable strategies. So these could be exclusions, excluding whole sectors of the economy that may not jive with your morals. So no tobacco, no alcohol. So exclusion, the old SRI, these reflect values. And you may have to give up performance in order to do that, not necessarily, but there's going to be another objective right alongside financial performance there. And then moving further down, you've got impact strategies. These are strategies that seek to generate measurable environmental and social benefits. They are seeking to make a difference. And so these more mission-based strategies don't necessarily negate solid financial performance. As Brad was saying, as long as you go through your fiduciary process in selecting these plan investments and they meet your financial criteria, you could be okay. But you need to really be aware that that there are mission-based outcomes that clients seek, as well as financial outcomes. The two are not mutually exclusive, but you have to be more careful as you go towards the mission-based end of this spectrum of outcomes. Now, underlying all of these approaches to utilizing ESG in the investment process is engagement. So this is active dialogue by the investment manager or an engagement specialist in order to understand risks and advocate for positive change. We'll talk a little bit more about that later. So let's spend some time on ESG integration, that where financial performance is first and foremost in the outcomes that we seek. So there are 3 levels of ESG integration. ESG 1.0 is the ratings, and that is using all of the ESG ratings out there in order to seek investments for your portfolio. So there are different ways that investment managers go about it. Some outsource their ESG research entirely to the ratings providers. Others use the ratings providers as a starting point and use proprietary analytics in order to come up with proprietary ESG ratings. And so ESG ratings, that's the first step. This can be problematic because it's based on corporate disclosure aggregation. So you've heard of MSCI and Sustainalytics. They comb the company's corporate disclosures in order to get the ESG data out of it. So you can already see where there's a problem if you're relying on this 100% because it's static. Corporate disclosures come out generally, the corporate responsibility reports come out once a year, and it's backward looking. It's looking in the rear view mirror. So if you want authentic ESG integration, you're going to want to look for more analysis rather than just picking the best companies according to an outsourced ESG research data provider. So that brings us down to ESG 2.0, which is that in-house materiality assessment as an extension of the primary research. In ESG, one size does not fit all. What's material to a healthcare company will be very different than what is material to a bank or a mining company. So you want to consider the ESG metrics that are most material to the company in which you're researching. And we have a lot of help with that. We use, you're gonna wanna hear your manager talk about SASB, the Sustainable Accounting Standards Board. They're a good provider with respect to materiality. And also materiality with respect to the ratings providers. There are numerous ratings providers and they're all good at different types of ESG data. And so you want to see your manager using the data from the appropriate data provider per ESG column. And then ESG 3.0 is engagement. And this is what I referred to before. This is sitting down with the companies that you're considering for inclusion in the portfolio and on an ongoing basis with investee companies within the portfolio in order to understand ESG behaviors under the hood. So there's no replacement for actually sitting down with company managements, company boards of directors to understand their ESG behaviors. And ESG behaviors are important because when you are acting responsibly toward the environment, towards your numerous human stakeholders, and when you're governing your company strongly, this is a good indication that you have a long-term focus as a company. So ESG information is often a good indication of long-termism. Well, there are 2 sides of the responsible investing equation: what is owned and how you own it. And together, these aim to generate sustainable wealth creation always for the end beneficiary investor, encompassing both investment returns and the social and environmental impacts of the investments. So on the left-hand side are all the different approaches to integrating ESG into the investment process. There's that negative screening, avoiding sectors. There's the positive or best-in-class screening, ESG integration in order to improve the risk-adjusted returns and your view of risk, and then the more thematic and impact investing. And then on the right is responsible ownership. And if your manager is a PRI signatory, they have committed to being active owners of companies and incorporating ESG issues into ownership policies and practices. So here is a look under the hood of ESG engagement and stewardship and what that looks like. So this is our group at Federated Hermes that sits down with managements and boards in order to advocate for positive changes. It's called EOS at Federated Hermes, and that stands for Equity Ownership Services, although we do engage on behalf of fixed income as well as money markets at Federated Hermes. We have 1.5 trillion in assets under advice, which gives us a good seat at the table with the managements. We also engage on behalf of other asset owners, not just Federated Hermes. And so that's where we get the 1.5 trillion. We have 68 engagement specialists and responsible investing staff. These are not CFAs, these are not investment professionals. These are ESG subject matter experts, and we have 68 of them really looking under the hood in order to understand ESG risks and opportunities at companies. This is a global team, 14 nationalities, speaking 12 languages, because it's important when you are advocating for big changes at a company to address the company in the language in which they speak in a culturally appropriate way. We have climate change experts, sustainability consultants, former heads of corporate social responsibility from industry. We have scientists, lawyers, accountants. These are ESG subject matter experts, and this is the biggest team you're probably going to find out in industry. We have 16 years of data on our ESG engagements on over 20,000 companies. So we can get an idea. We're not just looking at aged data, we're talking to the companies, and we have an idea of the trajectory of a company's ESG journey and the improvements that they're making in ESG. So corporate engagement, how it works. Looking at the lower left-hand side of the screen, we have a proprietary milestone measurement system. If somebody's investing in a fund and they want to know how the fund is having an impact or the improvement in ESG behaviors, they just need to look to the milestone system. So milestone 1 is when we raise a concern at the appropriate level at a company. Milestone 2 is when the company acknowledges that this is something that they want to address. Milestone 3 is when the company commits to credible change. And milestone 4 is when change is implemented. This can take a long time. We have many case studies that are co-authored and fact-checked by companies to verify our engagements and the changes that we're making. These are some of our proprietary ESG tools. We look at carbon emissions, governance. We've got an ESG dashboard with all the different inputs from 10 different data providers, married with the insights from our EOS engagement team in order to come up with a proprietary QESG score, as well as momentum on the trend in that score. And there's also emerging evidence that engagement drives value. So on the left is, because we have 16 years of data, it's often used by academics to prove the value of engagement. And on the left, you see the blue line is looking at all engagements over 1999 to 2009, and these are US public companies that have undergone engagement. The blue line are where companies have progressed along the milestones. So these are successful engagements. And we found that there is a 7% return over expected return in the 18 months following engagement. All engaged companies have a 2.3% abnormal return over the following 18 months. And unsuccessful engagements where companies do not progress, at least they perform as expected. We're not destroying value. Companies that are unsuccessful, do not progress through engagement, perform as expected. There's also ESG shareholder engagement and downside risk, and there is downside protection found when companies are engaged. So results indicate that shareholder engagement significantly reduces the downside risk of companies, looking at two measures: the risk-weighted probability of a negative return and value at risk. And the risk reduction effects are biggest when companies are further along in their engagement at milestone 3 or 4, and when environmental topics are addressed. So this is just bringing it all together to show a real authentic approach to ESG integration, which is meant to improve the risk-adjusted returns of an investment. So we start with all the good publicly available sources of ESG data. We marry that with insights from our ESG, our active engagement, and also through materiality assessments and proprietary data analytics to extract maximum value from the ESG data. And then we are able to use that in our security selection. And just 3 things to look for when you are considering an ESG manager, or how a manager uses ESG data to support long-term value creation. You're looking for a firm-wide commitment. You're looking for ESG not just in a silo, but applied across all asset classes and strategies. At Federated Hermes, we are 98% of our assets are ESG integrated, because we've proven the value of ESG, and we're all in. So you're also looking for dedicated ESG experts, not just PMs tacking on ESG questions at the end of their management meetings, but true ESG expertise. You're looking for proprietary analytics, an advanced ESG data analytics set that is improved by engagement insights to go beyond the outsourced ratings. And you're looking for expert active ownership. If your manager is a PRI signatory, they have committed to being an active owner, to advocate for positive changes towards all stakeholders. Think about it at the company level. If a company is not acting responsibly towards their supply chains, towards their customers, towards their distribution networks, the communities where they operate, and also the planet, they're not going to have a long-term sustainable business model or a company that's going to be around for the long term. So acting sustainably really does protect the sustainability of a business. For without a supply chain, without customers, without a planet, there can be no company. So I'm going to stop there and just tell you that we're aiming to make you a little more fluent in ESG. We're aiming to make you more confident and comfortable bringing it up with your stakeholders. And so if you're interested in learning more, definitely do look into the Responsible Investing Institute that was developed at Federated Hermes along with KKS advisors out of Harvard University. We have three modules. We can get 3 CE credits for this training, and it really will help you to build trust with your clients and just make you more comfortable talking about this important emerging trend. So I'm going to stop there and see if there are any questions for Brad or for myself.
Thank you very much, Mary. We will now open it up to a few minutes of questions. If you have those, please do enter that in the questions panel. Let's stick with ESG for now on the first one that's come in. For either one of you, Mary or Brad, we've seen a couple of different ways that ESG has been contemplated in a 401k lineup. One is a concept of potentially putting together a lineup of kind of mission-centric ESG funds alongside of maybe low-cost index funds. So the corporation is kind of giving participants a choice, but not forcing a mission on every employee in the company. Brad, maybe, can you share any kind of initial reaction or pitfalls, concerns to that concept? Because I do believe it kind of dovetails into the notion of your negative emission, or I forget the term you use, but half of that lineup would be only ESG funds. So you filtered out everything else. Do you have concerns with that?
Yeah, so as we were saying, you have a duty to act solely in the interest of the participants and beneficiaries, and you can't subordinate their interest in their retirement income to other considerations. So, as Mary alluded to, as you get closer and closer to mission-based ESG investments, then you start having a little more difficulty under ERISA because you're getting to where the goal of the investment is perhaps more focused on the collateral effects than it might be on the economics of the investment. So when you're looking in the ERISA context, you need to be making investment decisions that are first and foremost good investments. And ESG can be a factor to help make them good investments, or there can be a mission value to that is secondary to the fact that they are good investments. And when you start talking about negative screens, meaning to say, for active management, I will only look at ESG related funds. For passive management, I'll look at non-ESG funds. That's the kind of approach where you're probably not complying with your fiduciary duties as a general matter, because you're really excluding a significant portion of the investment universe before you've really had a chance to evaluate the economics of those. So I'm always concerned until, unless the Biden administration changes that with direct regulatory language. What we've been advising fiduciaries is to look at the investments that are available to you in a particular slice of your portfolio. So you're looking for an investment in this sector, in this area, and you want to look at both ESG related and non-ESG related investments that are available to your plan on the platform, and then decide based on all the factors you would normally look at. And incorporate those material ESG factors if you feel that they are being used in a way that is material as well. So it really is about making sure you're looking at the totality. Now, ERISA has said you don't have to scrub the universe for every available investment, but you do have to generally look at the investments available to a plan, and just whacking out half of them or 3/4 of them for a particular reason really is not doing the due diligence that you as a fiduciary need to do.
So maybe long story short, having an alternative that is not that isn't an ESG mission statement by nature isn't necessarily alleviating fiduciary issues. So having a parallel lineup that doesn't consider that might not buffer you from a fiduciary issue.
Well, every investment has to be prudent for your plan, regardless of what particular features it has. So if I'm looking at active managers, and I'll have ESG and non-ESG related funds that are going through that analysis, the ones that make it through my analysis are prudent. So if ESG related funds make it through, they're perfectly appropriate to include. If they don't, then they're not. And it's not because of the ESG per se, it's because of all the other analytics of that investment. So it's not that they're doing something wrong by saying we want to be open to sustainable investing. We want to include ESG related funds as competitors in our fiduciary process. That's exactly how a fiduciary should be approaching it. In the selection side of it, though, they need to be treating ESG the same as they would any other investment. I think that's really where we are right now. Now, again, that may change. The I keep doing that. The Biden administration may give us new new regulations that have specific rules for this. But for right now, you need to treat all investments the same for your ERISA purpose, and for the purposes of your ERISA analysis.
Okay, thank you, Brad. Mary, anything to add to that?
I was just listening to Brad speak, and so tell me if this is accurate, Brad. So in reality, nothing has really changed. You still need to put each potential investment through your process, and as long as you apply your process and you determine it's a prudent investment, it's okay.
Yeah, I think that's exactly right. And I think that's what got lost in this furor over the pecuniary factors rule and the confusion was DOL's been saying essentially the same thing about this since 1994, which is when they first adopted a rule that talked about economically targeted investments. So for almost 30 years, DOL's been saying, hey, you can consider all of these factors. The key is you have to have prudent investments, that you go through a prudent process, and you can't subordinate the interests of your participants to collateral goals. Your goal here is to do well for participants. And once you've done that, you can have a lot of additional factors or related benefits associated with those investments. So I think the final pecuniary factors rule was actually, even though its tone was very different and the history of how the Trump administration got there was different, the substance was actually very similar to the guidance in the Clinton administration, to the guidance in the Obama administration. But sort of the remarkable thing is that if you strip away the tone and analyze what actually happened in the 4 or 5 iterations of DOL guidance and regulation in this area, they have the same core principles. They just have very different tones around how they applied those principles.
All right, thank you both. We're going to switch gears completely to a rollover and PTE question. So will a rollover sourced as such from one 401k to another fall under the new prohibited transaction exemption?
It will, and DOL has specifically determined that that's the case. And here's the rationale. You're telling someone in a 401k where the money is starting, you're telling them to liquidate the assets in that 401k and send them somewhere else. That means it's ERISA fiduciary advice for the assets in that plan, as long as advice is going to be provided on a regular basis. So kind of the one exception to this new fiduciary rollover rule is a true one-time sales transaction. If, for example, you were recommending that they purchase a fixed annuity and you were never going to talk to them again after the sale, then that would be a sales transaction which would not be fiduciary. But DOL is saying, hey, if you're telling someone in a 401k to go somewhere else, whether it's an IRA or another 401k, and you're going to be giving them ongoing advice going forward as to how to manage those funds, then you're creating a relationship that meets the regular basis test and therefore is fiduciary, therefore is a prohibited transaction, and therefore needs an exemption to allow you to get paid.
Makes sense. Thank you, Brad. Let's close with, Brad, you mentioned that Secure 2.0 is likely to pass, timing uncertain, but likely not immediately. Any nuggets of wisdom that you might share as far as biggest impact or implication of that? Obviously, some things are more trivial than others. Do you have any gut feeling that something might be a big deal when that happens, or if that happens?
Yeah, so I really think the student loan provision is one that many of your clients are going to be very interested in. There's just been a lot of interest in saying, well, for particularly this youngest cohort of workers who have the largest amounts of student loan debt, they're not participating maybe at the level we think they ought to be or that they could be. And they're missing the value of compound interest. This is a great recruiting tool on top of everything else. So if we set it up so that when you pay your student loans, we make a matching contribution to your plan, you've really done a lot of different things there at once. You've improved your labor relations situation, you've improved their financial standing, and you really have provided both retirement benefits and other forms of financial security. So it's kind of a win-win for everybody, I think, is how Congress is perceiving it and how I think a lot of companies receive it. So I think that's going to be one of the most politically popular and sort of significant. One that I think is an unsung hero, but which would be actually quite significant, is allowing 403Bs to become part of PEPs, pooled employer plans, and allowing them to use collective trusts. I think that's one of those workaday sets of issues that I've heard a lot of advisors ask about in the past year or 2 years or 3 years on some of these questions. And I think that's one that's going to matter as well. But there's about 20 or 30 provisions that have one time or another been part of this discussion. So what came out of the House Ways and Means Committee last week is one version. There's several other versions in the Senate with a different grouping of 20 or 30 provisions. And ultimately, the final bill is going to combine all those, and there's going to be some winners and losers. So, it's hard to know exactly which ones will make it all the way through, but those are some of the ones I'd keep my eyes on. But there's a lot of other stuff in there that's significant to a lot of folks.
All right, excellent. Well, we've hit the hour here, so thanks again to Brad, Jim, Mary, and Federated Hermes, and of course, thank you all for joining us for this Epic Insight webinar. We wish you safety and health as you support your families, colleagues, and clients, and please don't hesitate to contact us if there's anything Epic can do for you. Thanks again, all. Have a great evening.
Thank you.
Thank you.